if you've had a chance to look through the white paper, you'll see that there are lots of facets to the practical delivery and some of the key barriers around viability and planning and procurement and the white paper does make an assumption that we need a CDEL compliant model, albeit there are other models that are being tested. But I suppose the CDEL issue is well understood in terms of a key limitation in delivering key worker homes. So we set out how that model looks and just declared that it was CDEL compliant. So I am going to have to talk a little bit about accounting and how we've got there. So if you could just bear with when we get to that point, and I will try and make it as user-friendly as possible. Thanks, Sarah. So as I said, we looked at multiple models in the white paper, and there are different stages of testing and maturity, and some cater to having CDEL in the pocket. But in the many cases where there is no CDEL, how do we deliver something? So we're running 3 or 4 business cases right now for different NHS trusts for key worker accommodation projects using this commercial setup, using this model. So it's in a kind of a practical application stage and some in a pre-procurement stage, which is really helpful because we were allowed that market feedback. Again, that's all on the basis of this model. And just to be clear, those business cases, and we're all here for the same reason, I mean, the strategic case is to solve the people problem. We need the homes, they need to be affordable, and we need to solve the people problem. That's really important. And then the economic case, I suppose, in your business case, is just the scheme design. How do we best, on that footprint of land, put a reasonable and top quality accommodation facility, and what's the best value for money way of doing that in terms of numbers of units and configuration that fits the staff survey that many trusts have done and fits what the staff demand needs are for that accommodation. And then that comes down to the commercial case, which then drives all of the outputs and the budgeting and the finance that allows this to take its next steps. So this is all done on the basis of this model, which, to describe very briefly, the trust will provide a land lease to the private sector partner, either at peppercorn or at value, and there's some flex in that, and depending on the model and the economics of the model. The trust will provide a land lease to a third party, which then brings their own capital to the table and builds and finances the accommodation facilities, which are then let directly to the NHS tenants. So the trust is able to enter into a nominations contract that effectively says, we get first refusal to put our staff into that facility. And where we don't have that take up, where there isn't demand, then there's a cascade of nominations that goes to perhaps other blue light workers or other public sector workers. And then beyond that, right down at the bottom of that cascade, they can be marketed on the open market. But typically the demand is so high, and we're all here today because we know that demand is so high. So that nominations contract is pretty tight in the sense that there is high demand for NHS staff. So then the investor or third party will take the rents directly from the tenants over a concession period, and then at the end of that period, that head lease will fall away, and then the property returns back to the trust. So all things being well, the investors make their money back as a result of the rentals, and then it returns back to the trust, and they carry on maintaining and delivering that accommodation thereafter. So that's kind of the model and how it works. I'm happy to take questions on that as if anyone has clarifications on that. The key point here is that the investor is charged with investing and building and then maintaining the accommodation, but also taking the demand risk or the void risk, if you like, and that's quite a key point, which I'll come to in a minute. So how's this done then? Why is this a CDEL compliant model? So I've got the accounting frameworks on the screen here just to demonstrate there are different ways of recording sets of books, and this is really important. So I'll try and get through this as quickly as possible, but in a way that is easily understood. So Treasury has its own set of accounts, which is under IFRS, which is International Financial Reporting Standards, and they have the manual on government deficit and debt. Separately, NHS trusts just use IFRS as interpreted by their FREM and now the GAM. Local authorities have IFRS as interpreted by the code, and higher education uses the SORP. It's just an important distinction because different organisations use different interpretations of how IFRS is used. So if we can move on, yeah. So for NHS trusts, they'll produce their set of accounts under IFRS, and then they produce a standard set of IFRS accounts. They are then consolidated into the budgets that then go into the Department of Health and then up into the Treasury. And it's that consolidation process that ends up being pushed through the manual on government deficit and debt. And basically, they're kind of the same. The MGDD just says use IFRS. However, there are a few differences, and those differences are very specific to the use of private capital in delivering infrastructure projects. And to be clear, private capital using to deliver public infrastructure has been going on for many, many decades. It's been very necessary for a long, long time. And typically a risk approach is taken on that to say whoever is financing something must own it, more or less. So why is this important in terms of the distinction? Could we just move on to the next slide? So for an NHS trust, in the model that we described earlier, using their IFRS accounts, they would have to follow IFRIC 12, which is a service concession accounting standard. And you don't need to read all of this right now, and I'm happy to take questions on it. But in a nutshell, if you apply the model that we put on screen earlier, it will determine that the trust has to record the value of the facility, the value of the new accommodation on its balance sheet. And before finance directors start to panic about the CDEL implications of that, there are those two distinctions and those dual sets of accounts that I mentioned earlier. But for a trust set of accounts, it'll have the facility on its balance sheet and a corresponding liability entry. However, moving into the MGDD, and this is the key point on the next slide, please. At a Treasury level and a Department of Health level, the model that we've described earlier is characterized as a PPP, which is effectively private money delivering public infrastructure, which, as I said, has been used for decades and decades. And as a basic rule, it takes a risk-based test and says whoever's constructing it and keeping it available effectively has that on their balance sheet. So it's not a public sector asset, and therefore no CDEL would be required. So that's how that model is constructed, such that it passes that construction and availability risk onto the private sector or away from the public sector. And as a result, no CDEL is required. And that's a really key point because it means that where we can get projects to stack up, and the ones that we're doing at the moment to stack up, we're confident that we don't need to make a CDEL application, and that makes things a lot easier to push through. This is also done in practice. If you're on the webinar and you're at an NHS trust, you'll know that in your financial submissions that go to the Department of Health at the end of the year, there's a key line in it which literally just eliminates all projects that are from private sector finance. And there's a specific line to eliminate that from that submission. So it happens in practical application terms as well. And this has been done, let's just think of a practical application in car parks, for example. So all of the car parks in the NHS, which are run by the private sector, were invested in by the private sector in terms of building those car parks, and then they collect the fare box from users of the car parks directly. And that model is no different. So it's not an untested or unused model in the NHS. It's just new to accommodation. And of course, there are some specifics around housing that are in the white paper around planning and procurement, which we need to get through. But nevertheless, from the finance side of things, it is a well-used and well-understood model. Okay, so on the next slide, just to be clear, and again, a car park example is very good for this. This is the specific guidance that the NHS released to help NHS trusts account for their car park projects effectively, which is to say, if you have private money coming into the NHS to deliver you some infrastructure for which you make no payments at all because the end users are paying, i.e. drivers, or in this case, tenants, this is how you account for it. And in doing so, there's no financial liability that sits on the trust books. Rather, you have deferred income, which is effectively a release of income to the trust's profit and loss every year. So it's a very neat and tidy solution because it kind of has a net financial zero impact on an NHS trust's profit and loss. So yeah, no different, and it makes real sense in terms of the accounting and budgeting. It's how do we get through all of the other barriers in terms of planning and procurement and viability, which are the really interesting bits. So just very quickly around benefits of the off-balance sheet model. Of course, no capital budget required, which is great. There's no underwrite required and therefore no risk apportioned to the trust. It is a tried and tested model. This model is also out for pending approval from Treasury. It's been well socialised and we're in discussions on that. And it attracts institutional capital. And of course, the best bit is, of course, the land is retained by the NHS. There's a residual value capture at the end of the contract. And these are all really big ticks for getting these projects away with a lot of the execs that we've been speaking to. Of course, in terms of risk, we do rely on market appetite and we rely on the right capital coming forward. We have to consider the tax implications in terms of SDLT and VAT, all of which your tax advisors will be able to deal with very well. Moving on to the next slide, we've got so just a quick piece on viability, and I think we're going to move on to how this links into the estate code in a minute, Sarah. But the typical model that we're looking at, in a normal build to rent scenario, and I think we have the right delegates today who understand that. In a normal build to rent scenario, you'd buy some land, build something, and then rent it out and recover your capital that way. So you would typically expect to charge a market rent. And this is really important. We're trying to solve a people problem here. We're trying to give NHS staff somewhere that is affordable to live on site. So we're reducing their travel costs, we're giving an uplift to their well-being, all of which can be recorded in an economic case in terms of that well-being and better workforce. But how do we get that discount? So a lot of the projects we're doing assume that the land value is transferred in at a peppercorn lease rate to the third party. And that's really helpful because the value of that peppercorn lease can represent kind of the fat in the model, the viability in the model, and you can then apply a discount commensurate with that, the value of that land that otherwise is put in at peppercorn. So while that's not kind of a means tested or salary band 1, band 2, band 3 tested solution, it takes the first steps to applying a reasonable and sensible discount that is mirroring the economics of the project. And we're finding some good success in that. However,